Welcome to Market Brief After Hours. We have a massive show for you today. Wall Street saw a dramatic shift in momentum with a spectacular surge in blue chip stocks, while the high-flying tech sector took a step back. It feels like investors are shifting their playbooks in real time. What exactly triggered this sudden rotation?
It was an extraordinary day of trading. What we saw was a classic market rotation. Investors pulled capital out of the heavily run-up semiconductor and artificial intelligence names and moved it into more defensive, non-tech sectors. The Dow Jones Industrial Average was the star of the show, rallying a massive 875 points, or 1.73%, to close at a fresh record high of 51,562. Meanwhile, the S&P 500 managed a modest gain of 0.41%, finishing at 7,584. But the tech-heavy Nasdaq composite actually underperformed, losing 0.09% to end the session at 26,831.
A record close for the Dow, yet the Nasdaq ended in the red. That really highlights how stark this division was. What was the catalyst for this sudden move away from the tech darlings?
It all started with a disappointing earnings report from chipmaker Broadcom. They reported a fiscal second-quarter revenue miss, which triggered a sharp sell-off in their stock. It plummeted more than 12%. Because semiconductors have been leading the charge in this bull market, Broadcom's slip-up caused investors to rethink their exposure to the entire AI trade. We saw broad declines across the sector. The VanEck Semiconductor ETF fell over 1%, ARM Holdings shed more than 4%, and Micron Technology dropped close to 8%.
So the AI rally is showing some signs of exhaustion. Is this a permanent trend or just a temporary breather?
Many analysts see this as a healthy pause rather than a collapse. The AI trade is still very much alive, but after an incredible 2-month surge, the market was simply getting tired. On top of that, there are broader macroeconomic and geopolitical realities sinking in. For instance, there is still no end in sight for the shipping stalemate in the Strait of Hormuz, which is keeping investors on edge. This rotation is a good reminder that not all AI stocks are created equal, and different companies have vastly different expectations priced into them.
Absolutely. And while tech was sliding, those non-tech names had a fantastic day. Who were the big winners driving the Dow's record run?
Healthcare and financials really stepped up to fill the void. UnitedHealth led the Dow higher, surging more than 5%. JPMorgan Chase climbed 3%, and Walmart added to the advance, rising nearly 1%. Outside of the Dow, we also saw strong gains in defensive and consumer-heavy names. Costco rose around 1%, and Eli Lilly jumped more than 4%. It shows that when investors want to scale back on high-risk tech, they still want to keep their money in the market. They just prefer more stable, cash-generating businesses.
That makes a lot of sense. Now, we can't talk about the markets without addressing the geopolitical backdrop. There has been a lot of tension in the Middle East recently, particularly between the U.S. and Iran. How did that impact trading today?
Geopolitics definitely added an element of caution. We saw escalated actions, including Iran striking Kuwait International Airport and U.S. Central Command defeating multiple Iranian ballistic missiles and drones. However, even with these tensions, oil prices actually retreated today, snapping a 3-session winning streak. West Texas Intermediate futures fell 3.1% to close at $93.04 per barrel, while Brent crude dropped 2.8% to settle at $95.03 per barrel.
That seems a bit counterintuitive. With rising tensions in a major oil-producing region, why did oil prices drop?
A couple of reasons. First, there were reports that President Donald Trump is reluctant to resume a full-scale war with Iran despite the recent clashes, which eased some immediate fears of a massive escalation. Second, recent shipping data showed that some vessels are successfully navigating through the Strait of Hormuz. While that doesn't solve the energy deficit or restore production in the region, it does provide some temporary relief to the supply chain.
That is a relief for the energy markets, at least for now. Meanwhile, we also got some fresh economic data out of the U.S. today, specifically on the labor market. How did those numbers look?
We saw a surprising jump in weekly jobless claims. Initial claims rose by 13,000 to reach 225,000, which was well ahead of the market's expectation of a tiny 1,000 claim increase to 213,000. This marks the highest level of claims we've seen since February 7th. On the other hand, continuing claims slipped slightly by 8,000 to 1.77 million. We also got some productivity data. First quarter productivity rose by 0.3%, which was below the 0.5% forecast, but unit labor costs only increased by 1.8%, coming in below the 2.4% estimate.
With jobless claims rising and productivity coming in soft, how did the bond market react?
Treasury yields took a breather as traders waited for the highly anticipated May non-farm payrolls report. The yield on the benchmark 10-year Treasury note slipped 2 basis points to 4.471%. The policy-sensitive 2-year Treasury yield lost over 3 basis points to trade at 4.045%, and the 30-year yield shed just over 1 basis point to end at 4.976%. It seems the bond market is in a holding pattern until we get that official employment picture.
Let's take a quick pause here, and when we come back, we'll look at how these global events are shaping European and Asian markets, dive into the latest Forex trends, and check out some major individual stock movers. Stay with us. Welcome back to Market Brief, After Hours. Now let's widen our lens and look across the Atlantic. European markets seem to have a pretty decent day, closing higher despite the geopolitical noise. What stood out to you there?
Yes, European stocks closed higher across the board on Thursday, finding some support from the news of a ceasefire agreement between Israel and Lebanon, even as U.S.-Iran tensions remained high. The Pan-European Stoxx 600 index finished the session 0.4% higher. Looking at individual countries, the UK's FTSE 100 rose 0.13%. France's CAC 40 gained 1.15% to finish at 8,244. Italy's FTSE MIB went up by 0.27%, and Germany's DAX rose 0.60%. Finally, the Swiss SMI settled at 13,341, gaining 0.93%.
Those are solid gains, but what about the underlying economic data in Europe? Was it as supportive as the stock indices suggest?
It was actually a bit of a mixed bag. In the Eurozone, retail sales volumes fell by 0.4% month-over-month in April, which was worse than the predicted 0.3% drop. Over in Germany, the construction PMI edged up slightly to 42.4 in May, but because it's below 50, it remains in contraction territory for the 5th straight month, with housing activity taking the biggest hit. On the brighter side, Spain's industrial production increased by 2% year-over-year in April, matching expectations. And in the UK, new car sales rose 7.1% in May, marking the strongest May since 2019. Interestingly, this was driven heavily by electric vehicles, as high fuel costs from the Middle East conflict are pushing consumers toward EVs.
That's a fascinating real-world impact of the energy crisis. Now, if we look over to the Asia-Pacific region, the story was quite different. It looks like they caught the brunt of the tech sell-off.
They absolutely did. Asian markets retreated sharply on Thursday, heavily pressured by that weak forecast from Broadcom. In China, the Shanghai Composite dipped 0.64%, while Hong Kong's Hang Seng Index fell 1.48%. Japanese markets were hit particularly hard. The Nikkei average tumbled 1.36% to 67,470, just a day after hitting a record high. The broader Topix Index also settled 1.11% lower at 3,951. This was compounded by Bank of Japan Governor Kazuo Ueda hinting at a potential interest rate hike this month, and Prime Minister Sanae Takaichi warning of currency intervention as the yen wobbled near the 160 per dollar level.
And what about the rest of the region? Did South Korea and Australia follow suit?
Yes, South Korea's Kospi out 1.84%, with heavyweights like Samsung Electronics and SK Hynix losing between 3% and 4% due to foreign selling. Australia's S&P ASX 200 ended down 1.13%, dragged down by banks and miners, despite a bright spot where Australia's goods exports grew 7.2% to a 3-year high of over 47 billion Australian dollars in April. New Zealand's S&P NZX 50 also slid 0.10% to close at 13,101.
With all this global movement, the foreign exchange market must have seen some fascinating technical setups. Let's break down the major currency pairs, starting with the euro and the US dollar.
The Euro-USD pair found a temporary footing, closing up 0.13% at 1.1613. However, looking at the moving averages, the broader picture remains bearish. The price is currently trading below its 50-day simple moving average of 1.1669, its 100-day SMA of 1.1697, and its 200-day SMA of 1.1680. Sellers still seem to have the upper hand here, and if the price breaks below the daily low of 1.1594, we could see further downside. And how is the British pound holding up against the dollar? The GBP-USD pair is consolidating, closing up a tiny 0.05% at 1.3424. It's sitting in a very tight range, narrowly below its 50-day SMA of 1.3451 and 100-day SMA of 1.3477, but just barely clinging to its 200-day SMA of 1.3422, which is acting as immediate support. It's a real tug-of-war between buyers and sellers right now. What about the Swiss franc? We saw some movement there as well. The USD-CHF pair fell 0.35% to close at 0.7893 after facing rejection at its 200-day SMA of 0.7904. However, it remains above its 50-day SMA of 0.7863 and its 100-day SMA of 0.7826, meaning the broader recovery effort is still intact as long as it holds above that 50-day average. Let's pivot to commodities and digital assets. Gold and silver seem to have staged a bit of a comeback today, but Bitcoin is having a rough time. Can you talk us through those moves?
Gold had a strong rebound, closing up 1.07% at $4,481, while it's still below its 50-day SMA of $4,627 and 100-day SMA of $4,794. It managed to hold crucial dynamic support above its 200-day SMA of $4,397, which is a very positive sign for gold bulls. Silver also rallied, closing up 1.83% at $74.02, remaining comfortably above its 200-day SMA of $66.69.
And what about Bitcoin? It seems to be experiencing a pretty brutal week.
Yes, Bitcoin is seeing its ugliest week in months, sliding to around $63,000. That's a drop of over 13% this week, and down 30% year-to-date. The main issue is that Bitcoin has lost its dominant narrative, and liquidity is rotating out of crypto and into other high-momentum assets, like the semiconductor rally, or even private markets, like the SpaceX IPO. We've also seen massive outflows from spot Bitcoin ETFs, exceeding $4 billion over multiple weeks. Some analysts think we are near a bottom at $63,000, but others are warning of a potential slide to $60,000 or even $50,000 if a fresh catalyst doesn't emerge soon.
That is a massive shift in sentiment for crypto. To wrap things up, let's look at some individual corporate movers that made headlines today. Who stood out?
We had some massive moves today. On the downside, PVH Corp, the parent company of Calvin Klein and Tommy Hilfiger, plummeted more than 20% after forecasting weaker than expected full-year earnings. Ciena Corp also tumbled over 13% despite beating earnings expectations as investors felt their full-year sales outlook was underwhelming. CrowdStrike fell more than 3% because their earnings beat wasn't strong enough to satisfy a market that has seen the stock double since March. Universal Music Group also slid 5.8% following news that Pershing Square sold its stake back to the company for €250 million.
And on the positive side?
Blackstone jumped 7.5% as investors brushed off news that the firm is limiting withdrawals from its private credit fund. Humana closed up over 6% after Morgan Stanley raised its price target. And, as we mentioned earlier, UnitedHealth surged over 5% following an upgrade to buy from Bank of America.
That's all for today's episode. If you find this useful, please follow Market Brief After Hours. Join us again tomorrow as we dissect the weekly close and analyze the highly anticipated jobs report.